The Thrift Savings Plan has launched some major investment changes. In this video, we're going to discuss some of the advantages and disadvantages of those changes. That's coming up, so stay tuned. Hi, I'm Jerome Harvey with Fedway Financial, and this is the Money Briefing. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you're new here, consider subscribing. Over the years, the Thrift Savings Plan has implemented several changes to keep up with the expectations and demands of both participants and stakeholders. When change occurs, there's typically pros and cons, and the changes that come along with the new mutual fund window are no different. The use of the mutual fund window is completely voluntary. The mutual fund window allows you to open a separate investment account within your TSP. Some rules and guardrails have been implemented that limits who can invest and how much you can invest in the mutual fund window. To be eligible, you must have at least $40,000 in your TSP account. You must invest a minimum of $10,000 in the mutual fund window. And no matter how big your TSP account is, you can't invest more than 25% of your portfolio into the account. Also, you can't make direct payroll contributions into the window, and you can't take loans, distributions, or withdrawals directly from the account. To complete those transactions, you must first transfer the money to or from a TSP fund. And lastly, you're limited to only 2 transfers each month unless you're moving money into the G fund. So now that we've covered a lot of the rules, I want to further discuss some of the advantages and disadvantages of the mutual fund window by mostly focusing on 3 areas: investment options, investment fees, and investment performance. The creation of the mutual fund window really stems from the desire to have more investment choices and the opportunity to better diversify your TSP. In most cases, having the ability to better diversify your portfolio is a good thing, but there's always 2 sides of every situation. Up until now, the TSP investment platform was limited to 5 core funds and 10 lifecycle funds. In many ways, that simplicity made it easier to make investment selections. With the addition of the mutual fund window, participants have access to roughly 5,000 mutual funds. With a fund offering of that size, it can become more complicated to research, select, and allocate your investments. It's almost like going out to eat. One restaurant may have a 1-page menu, and another restaurant may have a 20-page menu. The larger selection of food options may be nice, but it may be more difficult and time-consuming to choose your meal from the bigger menu. In the case of the mutual fund window, the bigger menu of investment options also comes with a bigger cost. The various fees are probably the biggest complaint and drawback of the mutual fund window. Fees are very important because they reduce your returns and long-term growth. Now, I know my federal employees and military personnel can appreciate a good acronym. So to help remember the different fees that are associated with the mutual fund window, I came up with the acronym MAV. So let's see how this MAV adds up. First, there's a maintenance fee. This has an annual cost of $95. Then there's an administrative fee, which has a $55 annual cost. As soon as you initiate your first transfer into the window, you will pay the combined fee of $150. For each year after that, the annual fees will be taken from your account on the last business day of the month of your initial transfer. In addition to the maintenance fee and administrative fee, there's a trading fee of $28.75. This is a transaction fee that is paid every time you buy or sell an investment through the mutual fund window. And lastly, there is a holding fee. This fee is expressed as the expense ratio. It's the cost of owning and holding a mutual fund, and it covers the various operational expenses of the mutual fund company. The expense ratios for mutual funds can vary significantly based on the type and size of the fund. In the chart, we can see that the average expense ratio for stock mutual funds is 0.63%, and the average ratio for bond funds is just over a half of 1% at 0.51. The next column shows the same expense ratio for target date funds, which are similar to the TSP lifecycle funds. And in the last column, the 0.05% represents the average expense ratio of the 5 core TSP funds. As illustrated, there's a sizable difference in the expense ratios between TSP funds and mutual funds. One of the most important factors that affect the expense ratio of a fund is whether it's actively or passively managed. So let's dive deeper into that. The investments offered through the mutual fund window are considered actively managed. They have a fund manager who regularly buys and sells assets with the goal of beating the market. On the other hand, TSP funds are considered passively managed. Their goal is to match the performance of a particular index or section of the market, and there is very little buying and selling. Because active funds require more hands-on work to conduct research and trading, they have higher average expense ratios than passive funds. The other big debate between active and passive funds revolve around investment performance. As I mentioned earlier, the goal of active fund managers is to beat the market, and some investors are willing to pay higher fees in exchange for better returns. But what does the data say? According to a report by Morningstar, just 26% of all actively managed funds beat the returns of their index fund rivals over the decade that ended December 2021. That 26% also tends to get smaller as the time horizon gets longer. However, to active managers' credit, they do generally have higher success rates in certain investment climates, such as when the market is volatile or when the economy is weakening. They also tend to have their best levels of success in certain asset categories, such as international stocks and global real estate. The mutual fund window definitely provides more options and flexibility, but the added research, the platform fees, and the lower investment returns of most mutual funds over the long term may discourage many TSP investors from participating in the mutual fund window. If you received any value from this video, please click the like button and share our channel with others. Also, feel free to add any responses or questions down in the comment section. Thanks for watching, and we'll see you on the next Money Briefing.